Hi, and welcome to the special edition of the Macro Show, Kingdom Under Siege. So it appears that the speculators have found themselves over the walls and into the royal court. I'm your host, Steve Van Meter. Never fear, my friends. This is just a one-time event, most likely in the big picture of the bond market. We're going to take a look at that. I've got a bunch of macro data for you, but let's get into really the reason you tuned in. What's going on in the bond market? Well, obviously heavy selling. So let's look at it from a chart perspective, because what's the data? Let's come back for a second here. What's going on in the, is it a data issue? Was there something like, super inflationary? No. People believe that a blue sweep or a red sweep or a sweep of anything is going to obviously turn the tides. So let's take a look at history here. We could not get inflation under full employment. That's when you're supposed to get inflation, right? I mean, that's when everybody's at work and they're making wages and spending money. We could not get inflation with $2 trillion or thereabouts of quantitative easing. We could not get it with the first round of stimulus. We're probably not going to get it with the current round of stimulus, but now because it's bigger, right? It's, hey, if we do more, then it has to be stimulative. If we give people $2,000, why don't we just give them $2 million? Maybe if we just give everybody $1 trillion, that will finally create the inflation we need. So there's this, big belief now that all of a sudden the Democrats are going to rewrite the Federal Reserve Act, directly print money. And I have trouble buying into these beliefs that suddenly, we have an economy that could not create inflation. We have the Fed that can't create inflation, but politicians can. Does that really make sense? It doesn't. So what's going on in the price action of the bond market? And what it looks like to me is these quantitative computer selling programs. And we've talked about this before. And some of you have even pointed out articles where you've seen that if the 10-year Treasury breaks 1%, there's going to be a flood of selling from these quants. Now, if you understand how these quant computers work, they're price levels. So they have a program or an algorithm they run every day. And it's based off of multiple time scales. And it says, look, at certain levels, you either hold, buy, go extra long, or you sell or go max short. So max long, max short. So the belief was that, hey, these things are going to start selling and go to max short. Well, what happens is over time, if prices aren't rising, the formula says it brings that level down to a sell signal down, and it looks like it hit last night. Now, how do you know that? How would I know that? Well, I've actually seen some pieces from some of the quants from time to time and looked at when they issued their signal and what happened in the market. You can easily see it here, especially over the last 90 days, where you have these just massive selling signals, and we've seen where just prices just get obliterated over a series of days, or sometimes just bam, all at once. And what's happening is when these computer programs issue a sell signal, it's like a trap door. It's like if it's big enough, it says get out and get out now, or go short, max short, just pound this thing as hard as you can. When they buy, it's much slower. As the prices rise, then they signal and they move in. But when prices hit a sell signal to the computer program, it means certain doom is coming, and they need to get out and get out quick. And so what we saw overnight was something that looked just like these. And of course, I consulted a friend of the show and computer expert Colorado Travis, as many of you know him on Twitter as Colorado Travis, and he agreed. He said, yeah, it looks exactly like computer selling here. And you can see just in the overnight, just slam down and slam down. And we've seen this before. If we go back 90 days, in the 90-day window here, you see this massive selling here in early November, and then boom, all of a sudden down the next day. In this course, panic. People get worried, and then all of a sudden, wow, look, a big rally right back up to pretty much where it started. But now, because it's down here and 10-year or 30-year yields are at 1.8, it's like this got to be the end. It has to be. I mean, it's over. But let's go look at a one-year chart and try to really put some perspective to this, because what you see today is what's called stopping volume. Now, what is stopping volume? It's when prices fall. So when prices are falling, volume starts ticking up. So volume, which is buy and sell transactions, and it hits a floor. And what does it mean when it hits this point? Is prices stop going down and volume. So I don't have a volume arrow, but I don't need one. I'm telling that to my wife who's watching. I don't need a volume arrow, but nevertheless, volume is goes up, and price just holds right there at the bottom. You see volume going up. That's called stopping volume. And what happens in these events is people want out and they're done. They're said, okay, my stop losses are triggered. This has gone down far enough. I don't believe in the view anymore. I think interest rates are really going up. I think there's inflation coming, and they exit. And yet someone underneath is buying it up. And what you have is these big days of volume and these candlesticks that don't move much. Now, where have we seen stopping volume before? Well, we saw it on this move here back in June. You can see, a big move in volume, and price came back off the lows and stopped. And you can see it right here. Sale came down, volume came up, put a halt to it. A couple days later, off to the races. Day later, off to the races. Here you see stopping volume. Prices go up. Here you see stopping volume. This is a beautiful candlestick right here. Prices went down, came back up during the day. Big volume move. Here you see it again. And you can if we even zoom in, and let's see if we can get a little bit better picture here. We have to cut out that kind of last move. But you can see as price came down, volume started picking up. And then all through here, price was flat. As people were getting out, someone was buying along in here, and then boom, come in the end, and you get this beautiful big move of volume and what appears to be a stop. Now, does that mean tomorrow it can start lower? Sure. Does it mean it's gapping up tomorrow? Sure. Could it just be right where it's at today? Sure. But what it's telling you is an end of a trend is coming. So you can see example right here. We got a big stop on the volume, and then prices came down the next day, and then finally made a move higher. So to me, it looks like this is kind of, at the end. Now, what we don't know about these quant computers is there's a lot of them, and they're aggressively selling. But the cool thing about when you look for a change in markets. Now, I thought at the end of last week, we saw that, hey, volume or prices were rising. We weren't seeing that, massive overnight selling. And so I kind of thought, okay, maybe the computer programs are done selling. Because when everybody's max short, which it appears they're going to get to, there's no one else to sell. And then prices start to rise. And what will happen after prices go up, right? And I don't have, where's my up arrow? As prices go up, then later on, these computer programs will come back in at higher and higher levels, and they'll buy back, and then retail investors and institutional and everyone will play chase. So, it still comes back to the economy is really deflationary right now. A blue sweep doesn't change anything. I mean, we've tried, borrowing money and giving people stimulus, and it didn't create inflation. Will we raise taxes? Will that be a plan? Possibly. I don't know. Is that the magic mix? Raise taxes and give people money? No. I mean, Japan's done this so many times before. We already know the outcome. Now, I want to share with you something from Breakfast with Dave, or not? Yeah, it is Breakfast with Dave, from Rosenberg Research. And I can't actually put this on the screen because it's a subscription piece, but he said, he's talking in his newsletter today about, is this potentially a depression? He says, government benefits account for 20% of total personal income. That's unheard of. Never happened. Full 20 million Americans we know are unemployment. 1 in 4 households, and as I read this to you, I want you to understand, we talk about this insolvency event, and people say, well, that's not going to happen. Yeah, 1 in 4 households, 1 in 4 have not been able to meet their monthly bills since March. And people say, look, all that cash in the M2, it's all pent up demand. No, it's called people can't pay their bills. They don't know what to do. They're holding on to cash. That's just incredible. 1 in 15 homeowners are in some form of loan forbearance. 1 in 15. Again, you get from the pressure from the market that, everything's okay. No, everything's not okay. And 3/4 of government stimulus, this was the only one we've had, except the current one, went to debt pay down and savings. Now, where did the other quarter go? Probably went into stocks and Bitcoin. But it gives you an impression kind of what the situation is out there, and it's not pretty. So I want to bring some other charts and show you what's going on in the bond market before we get in the economic data. And this is real estate loans, residential real estate loans on a year-over-year basis, and it's contracting, and it's done that only a couple other times because this data series really isn't that old. But what you can see is when there are contractions or decelerations, as this is here, it leads to lower interest rates. And I've got 30-year Treasury yields. Now, I know I probably should have put the mortgage rates, but we'll look at that in a second. Here is a deceleration led to a contraction. You had drop in yields. The market said, hey, this has got to be, super bullish. turned out not to be lower yields. Now, here's a rare case where you have an outright contraction in residential real estate, as we've seen now in credit, and you see rising yields as the market says, hey, this has got to be inflationary, and then it's like, oh, wait, maybe not. And then boom, lower yield. So here we have, a contraction in lending, and yet everyone's like, well, interest rates have to go up. Well, if interest rates go up and lending is contracting, it's going to contract even more and lead to lower interest rates. In fact, here's a chart of 30-year fixed rate and 30-year Treasury yields. So you have mortgage versus fixed rate, and you can see they generally kind of run right along together. Now let's zoom this in a bit because there's an interesting spot where you'll see that here's an example where 30-year Treasury yields were headed lower, mortgage rates were headed higher, and all of a sudden mortgage rates say, okay, I'm coming back down. And we can see down here, say in 2013, it looks like 30-year Treasury yields were headed up, mortgage rates followed. And there's some other events if we really spend some time looking at this. But what's happening right now is you see mortgage rates are just crumbling. And so the question now is who's going to be right? Are mortgage rates going to be right? Or is the 30-year that everyone thinks is going to 5-6% going to be right? And the question, or the answer to the question should be is, what are the commercial banks buying? They're buying a ton of mortgage-backed securities. Why? Because they're trying to keep and drive lower mortgage rates to spur credit growth. Well, that will likely mean the direction for the 30-year is also lower. This is not updated as of today, but nearly 90% of all S&P 500 stocks are trading above their 200-day moving average. That is generally a sign that things are way overcooked. And this chart from Real Investment Advice I thought was cool. A lot of people are like, well, we're going to have a major bull market. Meanwhile, gap earnings are crumbling down, and eventually markets have a reversion to the mean. And so that tells you that while everyone is speculatively bullish on equities, the economy is not. That's a really great chart, but mean to show that to you. All right, let's get into the economic data. We're here now at investing.com. Let's make this a little bit bigger so you can see this. And we'll start out with Spanish consumer confidence going into yesterday's data. And I only want to point out that the people in Spain are getting more confident, which is good. But hang tight. Now let's go to Canada because my friends up north. I don't know what IPPI is, but I imagine it's some form of producer price index. If you're looking for inflation, it went from 0.7 to 0. That's disinflation. The RMPI, I'm guessing it's maybe some regional producer price index, went from minus 0.3 to minus 1.7%. That is deflation. So further deflation in producer prices coming out of factories. How about Redbook retail sales? Slowed to 5.5% from this time last year. As we now move through the holiday seasons, it will be more interesting to see where this kind of settles. We've got the ISM. Now, many of you kind of got excited about this, and I saw on Twitter and messages, hey, look, this is really good. Let's break down the ISM because I've got some notes, courtesy again of Rosenberg Research today, which is really interesting. So I've got this manufacturing at a glance view. And what Dave said in his report today is when you look at prices paid, so this, which is listed here as prices, it's really high. It's at 77. Now, in theory, this is a diffusion. It's not in theory. This is a diffusion index, and in theory, these numbers could feasibly get to 100. Now, they're never going to get to 100 any more than they're going to get to 0. And so when people saw this 77.6 print, which tells you input prices at the factory are going up. Look, big move, 12.2% change. It's rapidly increasing. It's been doing that for 7 months. What does that tell you? Is people interpret this to mean the prices are rising. This is inflation. It means prices are really going to go much higher. Now, he said that recently, and he had charts in his report, which I can't show you, but he said in May of 2018, prices paid printed as 78. And over the next year, this consumer price index went to 2.8 to 1.8%. And the prices paid has an 85% correlation with stocks. So what he's saying here is that the ISM right now is telling us where we are. It's not telling us where we're going, and everyone's interpreting that to mean where we are going. So when you see some of these peaks, it tells you that maybe we're done with this big move. And if that indeed has an 85% correlation to the broad market, broad equity market, it's not a good omen. So let's go back and look at some of this report, because again, this turned out to be a massively inflationary and got people really excited, but it's telling you things are peaking out. Looking at backlog of orders. Now, normally this is a good sign of demand, and this is a pretty good number at 59. It's been rising for 6 months, which is good. But then you'd want to look at inventory levels. So this is inventory at factories. And what you see is it's in a 3-month trend at 51. So it's not super duper high, but it's getting high. Now, everyone teases me about, oh, you can't see inflation, you can't see inflation. Look, do you understand that inflation means that prices are going to go up tomorrow, the next day, the day after, a year from now? It means prices are going to rise, and not a little bit, enough that you want to buy today. So for example, in Weimar Republic in Germany, prices went up so much during the day, they had to pay people twice a day so they could go buy stuff before their money came worthless. Now, if people really, truly believe there was inflation coming, first of all, we wouldn't see a big stack of money in the M2s, in checking and savings accounts, because people want to get rid of it, because it's going to become worth less and goods are going to go up in value or price, so they need to get rid of that money. We would also see the velocity of money start to move, because we want to see money exchanging hands. And you would also expect to see at the factory level people just buying stuff. Hey, I don't need this today, but it's going to be so much more expensive down the road when I need it. I'm going to go buy it now. So these aren't really an indication of inflation. Now, customers' inventory, it says too low. So this is potentially a good sign that this number will be filled. But what it's saying at the factory level, they're starting to build up inventory. And how about employment? This has not changed. Look at November, it's at 48. This means it was a slight contraction in November, slight expansion in December. It has not been moving months. Its trend is only 1 month, which tells you that factories, these are purchasing manager reports. They're not convinced that demand is coming, because then they need to add employees. Production, massive high. I didn't catch what Dave said on his chart, because the ISM puts out charts, but they're only till 2018, so they're not real far. New orders were up. So what we're potentially seeing here is a peak. Now, for all of you dollar bears, check this out. The ISM PMI has a 70%, so the broad number here has a 70% inverse correlation with the dollar. So if indeed the ISM is showing us that this potentially is peaking out, then it tells you the dollar is likely to reverse. Now you look at demand, you see imports up slightly, 6-month trend growing at a slower rate. But how about new export orders? It's starting to peak and slow down. So you're looking at demand going out of the factory. You're not really seeing a lot there. So when you look at this print, especially the prices paid, where everyone's like, inflation, 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 it's realistic. You might have already seen it. This may be kind of it. And if that's the case, well, then where are Treasury yields headed? Yeah, they're headed lower. All right, let's go on to the next chart. Or actually, you know what? Let's go back to economic data. What do we got here? Let's see. Europe. Okay, let's get into the Eurozone. How about French CPI? Went from plus 0.2 to 0. This is preliminary. So again, disinflation in French CPI. How about Spanish services PMI? Still second month of contraction, although a very slight contraction, means nearly unchanged from the month before. And yet people in Spain are optimistic. Maybe this is the bottom there. I would hope so for their sake. How about the composite PMI, which is a blend of manufacturing services in Italy? Another month of contraction. Italian services, another month of contraction. French composite PMI, unchanged. So it contracted the month before, unchanged this month. How about in Germany? Remember, this is the big, the German factory juggernaut here. Composite PMI, very slight increase at 52. So it looks like it's starting to stall out. Services, still slight contraction. Not a good sign. How about the overall Eurozone? Composite PMI from market, unchanged after a slight contraction. So you're seeing, a stalling out in these reports where things aren't growing. But Eurozone services PMI, slight contraction. How about Great Britain? Composite PMI, unchanged. Again, we're supposed to see this global recovery. Eurozone PPI, minus 2% month before, minus 1.9, still deflationary. So you know, people are like, oh, inflation is coming to America. It's probably because the dollar was down, not because of anything else. How about German CPI? Year-over-year preliminary, minus 0.3%. The month before, minus 0.3%, deflationary. Let's go on to the ADP non-farm payroll report. Everybody, man, the market really actually liked this report, even though the expectation showed 88,000 jobs growth and actual printed at a minus 123,000 jobs. Way missed expectations in December. You know, and normally, as many of you know, December's a month, you know, there's a lot of hiring still going on for the holidays, which obviously didn't happen this year. So what does that spell for things in the months to come? How about car sales down 2 months in a row? You know, you look for inflation, and if people really thought prices were going up, they'd be buying more cars. Now, truck sales were up, and let's see how they are compared to where they've been over the last 5 years. So the truck sales are pretty much right back where they were. Car sales, on the other hand, are not. I mean, you can see car sales here pretty ugly. I mean, a little bounce and is now rolling over and headed lower. I mean, again, if you want inflation, I mean, if you really think there's inflation, then that means these things are going up. You need to go buy one now. How about the market composite PMI? Slowing, still in expansion at 55, not a big expansion, but the trend now is slowing. I think market does a little bit better job of the ISM on the overall headline report. Services PMI, a little bit better than slight expansion, but from 58 the month before to 54 now, slowing. That pace of expansion and growth in the U.S. economy is slowing down. Let's move into crude oil. We saw an 8 million barrel draw, which on one hand is great, but again, let's come back to this inflation view that everyone has. Well, if there's all this inflation coming, then shouldn't gas prices be going up? And then if that's the case, then why are inventories building at 4.5 million barrels? Shouldn't everybody be out filling up their cars and their, you know, and tanks in their backyard and anything they can and buying as much gas before prices go up? How about distilled stocks? You know, this is, you know, a lot of this is jet fuel plus 6.39 million barrels, 6.4 million barrels. You know, if there was inflation, if there was this fear of inflation, people would go out and buy things and store it or hold on to it before prices went up. Let's see what we got next. Commitment of traders reports from our friend Stefan showed the speculative position increased 7,000 contracts. And here's looking at TLT, which is obviously now down from this chart. And you still see some heavy speculative positioning here, which I can only imagine has gotten bigger after today and what we've seen over the last couple trading days as speculators look to likely be increasing their short position. You know, some people said, well, look, maybe a Biden presidency and a blue Congress will be super inflationary. You got to go back to some history and see when that was. There was the last time we had a blue wave, and that was around 2007 to 2009. And let's zoom in. Here's 2007. Right in here, bond prices went up and made new all-time highs. Sounds great to me. Before they went back down, some people say that also means the dollar's going to get weak. But our friend Brent Johnson posted on Twitter, and my chart doesn't go quite back as far as his does, but here you can see that into, you know, this is 2008 into 2009, the dollar rose before it fell. So not much of a story on that. Stefan also provided one of his favorite charts. It's market buy sell signal. I don't recall if this is like a relative strength indicator, but it is a blend of, I believe, 30 major indices. I'm sure he'll correct me because I got this wrong, and then we'll look at it again next week. But he likes this chart because it shows that when this value is way up at the top, it is more likely to indicate a move lower. Now, there can be periods where it stays up there, 2012, 2013, 2014. But when you're late cycle in longest expansion in the history of the U.S., in the middle of a raging pandemic, that with 20 million people unemployed, the chance of this thing going down is more likely than not. So what will happen when all this speculative stuff gets done? You know, we're going to have a huge, huge party in the bond kingdom. And I tell you what, we're going to be drinking Speculator tears. That's right, speculator tears. So just so you know, a fan of the show locally made this mug for me. It's not for sale, but I just thought speculator tears. Yeah, we're going to be drinking speculator tears, my friends. Anyways, thanks for watching. I know the show went a little long. I'll see you on Friday, and where we'll get into the credit data. Thanks for being fans. Thanks for staying with me, and I will see you on Friday. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. It is not to be construed as recognition or solicitation to buy or selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Meter, and my own personal capacity. Opinions expressed in this video or that video do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.